I'm Charlotte McLeod with investingnews.com, and here today with me is private investor Don Hansen. Thank you so much for being here. Always great to have you on.
Yeah, well, I am too. And it's interesting with all the changes and activity in the markets generally. It's probably timely to take a look at where we are, where we've been, and give folks something to think about in terms of their decision making, in terms of their investing, particularly in gold and silver, because some of them are a bit nervous about things because the prices are down, particularly with silver. So I wanted to talk about all of that. So let's get started.
Well, always good to have you on. I think it's going to be a great conversation. I always enjoy talking to you. I know our audience loves to hear from you. And today you've put together some great information on how the world got to where it is today, what could be coming next, and probably most importantly, what investors may be able to do. So we're going to start with a look back at the past. You've done a deep dive into how the US came to have such a high level of debt and a growing level of wealth inequality. So let's jump in and see what you have there.
I'm going to step back even further and just look at the basics of economics. I'm a believer, as you know, that the very best way to organize an economy is what we call a free market capitalism. And there's three pillars of that concept that are critical, that need to exist for you to really practice that. The first is sound money, which is money based on something real. And historically, that's been gold. The second is limited government. And the third is free markets, where the prices of things and the quantity produced and all that is decided by the citizens who vote with their money. So the interesting thing about that is the polar opposite of that, where there's the government controls the money, the government's power is unlimited, and the market prices are all set by the government. That would be the communist dictatorships, the Soviet Union, Mao Zedong's China, currently North Korea. And that system tends to end up with a tremendous amount of equality. 98% of the people are all poor, but they're equal, and the other 2% are the elites and their entourage that run everything. And that's how that system works. Free market capitalism, on the other hand, has historically produced much, much greater prosperity for everybody, large middle class, much less wealth inequality. And so I use those in my thinking to say, okay, where are we with all of that and what's actually happening? And the thing that I am struck by as I think more and more about this, and a lot of people who are even into gold may not realize the extent to which backing the currency with gold is actually the most fundamental piece. Everything else evolves from that. Because if the money is restrained in terms of its quantity by the backing that it has, then the government can't increase the money to increase itself. And then if the government doesn't get too much bigger, it isn't inclined to interfere in the market. And so that's why you see that. So then I thought, well, let's historically look back over the last couple of 100 years and see what was going on and what the pattern has been. And the interesting piece of that is, if we look in the era between the end of the Napoleonic Wars in 1814 and the beginning of World War I in 1914, we had in Europe and the US and Canada an extremely prosperous era. We had an industrial revolution and a tremendous increase in standard of living for everybody. And it was extraordinary, large expansion of the middle class, the growing population, and all of that it was really based on the fact that we were practicing free market capitalism, not perfectly and not all the time. I mean, certainly there was periods like in the US with the Civil War and the Europe had its issues and so on. But by and large, it was pretty consistent that we had sound money. And that was the rock solid. And then we did also had limited government. And part of the reason we had limited government is that up until 1913 in the US, the government had no income tax. So they got their revenues from tariffs and other things. So they didn't get a lot of money. And so they couldn't get large and intrusive in the markets. And so but I want to make one other comment because there's a lot of libertarians out there in our audience who are going to say, well, wait a minute, you need to have some government. And I'm not an anarcho-capitalist like Doug Casey, who you know, who doesn't think we should have any government at all. Government is very important because I think it acts kind of like the referee in a hockey game or a basketball game, where, in that ideal situation, the people would decide their representatives. The representatives would decide what the rules are, and the government would enforce the rules like the referee to make sure that the competition is fair for everybody, and that it also provides for national security and the borders and so forth. And in case of emergencies like earthquakes and hurricanes, they are helping people and all that sort of stuff. So there is absolutely a role for government. So I don't want anybody to think that I'm going there. I'm not. But I just think that we've gone way, way beyond the level that we needed to and should. And the key change happened in 1913 in the US when the government basically established an income tax and a central bank. And that was the beginning of then major shifts, although we were still on the gold standard. And so up until, between 1914 and 1945, you can't really even look at that period with any kind of conclusion because it was total chaotic. We had 2 world wars and on depression and so forth. So I don't even try to figure anything out of that. In 1945, though, we then created a new gold standard system, only it was only international, the Bretton Woods system, but the dollar was based on gold at $35 an ounce. And so between 1945 and 71, we had a relatively good period. The gross domestic product was growing faster than debt. We had, in the US, mostly balanced budgets. So we were able to then, by having the GDP growing faster than the debt, reduce the very large debt to GDP that we had at the end of World War II down to much smaller, from 120% down to 40, I think, somewhere in there. So that was but of course, the sad part of it, that is that the US government basically defaulted on the Bretton Woods arrangement, and they kept creating money because they could, and there was no restraint domestically on the dollar. And so then the Europeans in particular wanted their gold instead of the treasuries in US dollars. And so the gold stash of the government went down from 16,000 tons to 8. And that's when Nixon basically ended that. And then we started the new arrangement in 1971, approximately, with no backing for anybody's money. And that was then the critical area where then the governments, there was no restraint on what they could or would do. And of course, being the bureaucracies, they always grow and get bigger and bigger. And so it's gotten all the way up to where we are now, with the US government's debt at 120% of GDP and growing ever more rapidly. And government spending, instead of declining in the US, is grown. Most people don't realize that very recently that accelerated enormously. The US government spending in the era between 2016 and 2019 was increased in the next 4 years, from 2020 to 2023, 55%. 55%, okay? And it hasn't gone back down to the lower level or even close to it, which is why now the US government is running deficits of 6% of GDP, and the debt is growing ever more rapidly. And so I thought that we might pull up the figure one that I had sent you, and we could look at the audience can just see how that's evolved over time. You can see we started out with a low money supply and low debt. And the interesting thing here is how the money supply followed and tracked the debt. Well, we shouldn't be too surprised because the money to fund the debt has to come from somewhere. And the government managing the banking system has made sure that the money supply is basically growing about 7% a year, which has been the case ever since we started with this new monetary system. And that you can see, though, that it's growing exponentially. And that's really important for the audience to understand, is that it's growing exponentially, which is a very serious situation considering where we already are, with the debt being like 120% of GDP, because the interest expense on the government's debt now is getting so large that it's starting to become a serious problem, because then the more the interest expense goes up, the bigger the deficit gets, and therefore the debt gets bigger, and so there's a feedback loop there that's really dangerous. And the other thing about it, that to know where we are at this moment with that situation, is that we have about $40 trillion in debt, and the average interest rate on that is about 3%. But our 10-year treasury is already 4.5%, and the 30-year is 5%. So as we roll over the older debt, the average is going to keep going up. And as well as the fact that we're having $2 trillion a year deficits is going to add to the debt, which means the interest expense is going to go up even more at a more accelerating rate. And so what that is telling me, and a lot of other people who talk about this subject, is that the current situation for the US and basically for the rest of the world is that we're in what they call a debt trap. And the debt is a trap because basically whatever the government does from this point on now, the Federal Reserve, whatever it is, it's going to have a negative result. If inflation starts to take off, they can't raise interest rates like Volcker did in the 1980s, because if they did, then the interest expense would go astronomically high and the budget would get even worse. And so it would make that whole situation more serious. And if we go into a recessionary period and they try to reduce interest rates to increase borrowing and stimulate the economy, then inflation is going to take off, and then that is going to rates will go up as well. So they're really in a tough spot right now, and that's a pivotal thing to understand. How that's going to turn out, nobody knows, but it's important to understand that we are at a very critical point in this whole process, and that it can't go on forever. Something will change. We just don't know exactly what or what that's going to look like. Okay.
Yeah, I think that's a great overview showing where we are today, how we got here. And yeah, it feels a little bit dire for people. It could be a little bit alarming to look at this. So anything further you'd say on the current situation and where we're going, or is it time to take a look at how investors might want to position right now?
I think that what it tells us is that we need to think about how we can protect ourselves. And I guess the scariest thing too to me is that none of the politicians are talking about this. Are you hearing any of them tell people what I'm telling you now?
No, absolutely not.
Which is why it's so scary, because it's like, huh? No, or don't you get it? This is not rocket science here. This is pretty straightforward stuff. And they're not getting to that. We can get to the gold and money supply curve a little later, just to show, because it gets into what can you do. Well, obviously, you have to focus on investments that allow you to protect yourself. And I want to get to that. But the other thing that I think is interesting to look at in terms of people, particularly because there's an effort in the U.S. to say, well, and the Trump administration is saying this, and it's about the only thing they can try to do, which is to increase the GDP faster than the increase in the money supply. But the trouble is that the situation is such that you're not going to be able to do that. The GDP growth has been declining over the last 3 or 4 decades. From, I think it was 3.5% a year in the maybe 1980 to 2000, and since then it's about 2 or a little over 2. So and there's a bunch of reasons for that. One of which is the population is declining. The number of people in the workforce, active in the workforce, is not increasing, and GDP growth is depending on more people working and being more productive, and they're not. And then, of course, we have the M2 growing because of the increase. The other thing I wanted to talk about very briefly, because it's interesting, we talk about inflation and all that sort of stuff, and the difficulty with that term is that, as Milton Friedman has said, inflation is everywhere and always a monetary phenomenon. In other words, it's not just the CPI, it's just consumer prices. But when the money supply increases, it doesn't just go to consumer prices. It goes to equities and real estate, which is what's happened over the last 25 years, where that's where most of the money has gone, as we know. So anyway, I just wanted to comment on that, because I think there's a lot of people who don't realize how important the money supply aspect is, and that the consumer price index is just a collection of particular prices that the government chooses to make things look better than it is. But anyway, that's enough of that.
Sure. Yeah, I think people might know that CPI isn't representative of what real inflation is like, but maybe they don't know all the components and exactly how it breaks down. So definitely that's a good one to go over.
Yeah, and that's why the wealth inequality has been so disparate, because the money has gone into real estate and equities. Well, it's the top 10% that then is able to take advantage of all that, and of the low interest rate situation that was caused by the Federal Reserve. And the rich, the top 10%, have gotten extremely wealthy from that, from the increase in value of real estate and equities. Whereas the ordinary people, all they would have maybe is government bonds. And when the government interest rate, on the 10-year Treasury goes down to 1%, then they get nothing. And so the disparity has gotten greater and greater, which is just the opposite of what would happen if you actually were under a free market capitalism system. I want to emphasize over and over is a free market capitalism. We have a hybrid of that where we've been steadily moving away from it and more towards bigger government and with no sound money and all that. And that's the consequence. That's where you end up. That's just what, then you end up like North Korea ultimately, where the wealth inequality is enormous, except for the bottom 98%, because they're all poor. And so, and I understand that a lot of younger people don't understand some of these things. So they think, well, capitalism is a failure because we have all these problems. No, that isn't true. The problems are because we haven't been practicing free market capitalism, or hardly any of it anymore. So anyway, I just needed to make that point, because I'm concerned that there's a lot of people that don't understand that our circumstance is not because capitalism is failing us. It's because we're failing it.
Yeah. You get used to hearing these words and maybe you don't know what the actual definition is. So it's important to go back and think about that before you're passing judgment. So very, very useful to go into.
Good. Okay. So what should we talk about next?
Well, I have still the chart on the M2 versus gold. Is that
Oh,
one that we
yes.
need to look? Yeah, here, let me
Okay,
put that
let's do
one.
that.
Let me
Because
put that.
that tells us a lot about where we go next.
Yeah, and I think that's important. Here we go.
And here you can see that the gold price has gone up as the money supply has. Sometimes it's grown under it, and well, most of the time under it, because you can see in 1980 when we had a bull market, then gold was had high price, didn't stay there, but now we've all of a sudden seen where it's changing significantly, and the gold price number that you see there is the January 1st of 2025, which is under $3,000. Well, you know where it is now. It's up by 4,500 in a year. So obviously, what we're seeing now is that the gold price is really catching up with the money supply, but it tracks it, but it's not right constant to it. And of course, the reason for that is that the gold price is affected by multiple things. And there's two in particular that people hear about, but they're the most important. And that is, number one is the central bank buying and selling of gold as a reserve asset. And the other is the status of the stock market, particularly the US stock market. And what we saw in the previous bull market in gold, which was in 2000 to 2012, we had a bull market, but it never really caught up with the money supply. But the reason for that is that of the two factors that I talked about, the stock market was in a bear phase from 2000 to 2012, 13, to the point where if you invested in the stock market in 2000, you made absolutely no money on a nominal basis by 2013. And on an inflation adjusted basis, you lost a bunch. So money came out of the stock market and went into gold. But during that same period, the central banks were selling all the way through. Okay, then by the time we got into 2014 or thereabouts, the central banks flipped completely and they started buying 500 tons a year and every year. And then by the time we got to 2022, they were starting over 1,000 tons a year. And that has what has put the gold price now up to where it's $4,500. But the stock market has still been in a huge bull phase. So we haven't even seen what happens when the money starts to come out of the stock market and go into the gold price. So what I'm trying to tell people is that this bull market in gold is just starting. It's just starting to get going. And the money supply is going to keep growing, but you're now seeing an impetus to push the gold price up a lot further and a lot faster, because we're going to have a stock market correction. Okay. I mean, the stock market's bull phase is now is in its 17th year. And the longest ever before that was 18 years, between 1982 and 2000. And the S&P is up from like 800 in 2008 or 2009, I guess was the bottom, now to over 7,000. So, I mean, it's been a huge increase. And everybody recognizes, who's analyzing the stock market, that, it's extremely overvalued by any kind of a measure. And the expert analyses I've read is that if you were to buy into the US stock market today, in 10 years, you would have made no money on a nominal basis. And of course, inflation adjusted, you'd lost. So this stock market is on very thin ice. And when that changes, there's going to be a lot of money moving into the gold market. And just to give you an idea, people say, well, gee, the gold price went up, so, maybe we're all saturated. That isn't even remotely true. Not only is the gold market, central banks have been buying, but the investors have not been buying gold yet to any significant degree. There's a very interesting statistic that I read where JP Morgan, that analyzes things that family offices do. These are basically the organizations that the very wealthy people use to manage their money. And they surveyed 333 family offices. And they found 72% of them own no gold at all or anything related to it. 28% had some, but it was only like 1%. So until the U.S. stock market unravels, which it ultimately has to be, because it's at the peak of its cycle now, or very close to it. Everybody agrees to that and can't wonder why is it still up there. When that money starts to shift and go into the gold market, then you're really going to see a lot of price increase in the gold price. So I think that's why I'm so convinced that the place that investors should be is in gold and the gold miners.
Well, and before we talk a little bit more about gold and the gold miners and how to position, I want to also bring up central banks. You've told us for years at this point how important central banks are for supporting the gold price. And when the Iran war began, there are a lot of headlines people were seeing about some central banks selling gold. So I think that created a lot of questions about what's actually going on there. So maybe you can talk and assuage some of these worries. Yeah.
Yeah, I would be happy to do that. I looked at some analysis that showed central bank buying for this year. Actually, they were selling on a net basis in January and March, and buying in February and April. And so they're still buying, but the buying's down a bit. But there's only two countries that are selling significant amounts. One is Russia. Well, guess what? They've been in a war for 4 years, and they've been sanctioned, so they're not selling anywhere near as much oil as they were. So they need money because they're at war. So they were selling, and they didn't want to. And the other country was Turkey. And I think the problem with them is that this is a rather poor country, high inflation, the economy sucks, and they need to buy oil because they don't have any of their own. So what are you going to, in order to raise dollars to buy oil, which is now much more expensive, they had to sell gold, and they had quite a bit. I don't know how much of it they've sold already, but they were the major seller. Everybody else is still buying, the Chinese, the Indians, and so on. The Poles, and Poland is buying, has been buying a lot. Eastern European countries, the Czech Republic, other places have been acquiring it as well. So no, the central bank buying thing is not over, but yes, there was some of that. But the mainstream media is not pro gold. So when they see a little bit, there's been a little selling, then they make this big deal about the gold central bank buying thing is over, and gold is going to go down. No, that isn't reality. There's still plenty of buying, but yes, it has been this year less than it was. But hey, look what we did in 2025. The gold price was up 65%. I mean, come on. That doesn't happen all the time. I wouldn't be at all surprised if we didn't get an increase in the gold price at all in 2026. We had it all last year already. I mean, there's you got to be somewhat realistic about what's an expectation that makes some kind of common sense. So, no, I think it's just the media making a big whoopee about that, and it isn't that big a deal at all.
Yeah. I think it's important to remember where you're getting your information from and step back and get the big picture. And I think, talking about gold's performance maybe takes us in the next direction we want to go, because you've been telling me how you should have your physical gold as insurance policy. But if you really want to take advantage of potential gains in the market, you should take a look over at the mining stocks. So maybe that's where we should focus next.
Okay, so let's do that. Yeah, the thing that I advocate is that you would look in terms of gold and silver too, in a different way than a lot of people are. I look at gold as financial insurance, which, like any kind of insurance, car insurance or house insurance, you don't buy it and sell it. You have it all the time, right? And if gold is your financial insurance, you buy it and you don't sell it. You don't trade it. You just buy it and you accumulate it and you keep it until there's a family emergency or something really, really serious. But that's why you keep it. That's why if the house burns down here, something terrible happens, then you have a reserve where you've got a policy, savings, or whatever. So that's the way I think you should look at gold. So for me, I'm never going to sell an ounce. And I'll give it to my children and their grandchildren and so on and so forth, because that's what we should look at it as. That's how you're going to protect yourself as the money supply goes parabolic. At the very least, if you have that, the purchasing power of your money is going to be protected so that you can maintain your lifestyle to some semblance of quality. Okay, so that's an important distinction that I've not made before, but the more I think about it, I think it's really critical to think about that. And I give credit to Rick Rule, who has made that same comment in the past. And the more I think about it, the more I think he's absolutely right. Then the other thing that in terms of the mining stocks, that is if you're looking at, so you've got the insurance part, and then if you want to invest to make a profit, which the best way to do that? And the best way to do that is to invest in the mining stocks, not in bullion. And the reason is that history and very recent history shows that when you're in a bull market in gold and silver, the increase in the share price of the miners goes down by 3 times more than the metal does. 3 times more. And I collected the data for my portfolio for 2025, and we can show that as figure 3, because what it shows there is the fact that there's the multiple, and that's what you see on the far right side, times the gold price. And the companies that I'm listed there that have an X to the left of them, as it shows, is my favorites in my portfolio. Most all of my investment is, and you can see what they did. K92 2.5 times, G Mining 4.4 times the price of gold, Eris 5.3 times. Then I also got GGX, which is the ETF of all the gold mines, and that was 2.4. But of course, the problem is that with the GDX, they have everybody, the good, the bad, and the not so good. And then I have also Newmont and Barrick, just to give you a comparison. So you can see that if you want to make a profit, you want to be in the miners, not in the bullion, because this multiple is for real. And the other thing that I wanted to show back at the bottom is if you averaged the increase in the gold and the share price times the gold price for the ones in my portfolio X, it was 4.2 times. 4.2 times the gold price, which was 65%. In other words, I had a good year.
Yeah. Congratulations.
And I mean, that's how I can afford to buy the house I'm just living in here in Naples. But I hope that I've been advocating these particular companies for a while with the Investing News Network podcast that you and I have done. I hope that people actually took my advice, because if they did, they would have done very well as well. But the important thing to think about here is to understand the leverage that you have in the mining shares against the bullion price. So if you're investing to make a profit, this is the way that you do it.
It's really good to look at your examples here with all the numbers laid out. I think it really helps show, here's what the mining stocks do as a group. And then if you take that extra effort to choose ones that you think will do well, you can do even better. And maybe a question that people will be wondering about is, how did they decide when to sell, right? We had this huge run up in January in gold, silver, the miners. Now we're in a little bit of a lull. So anything you could share on that note for people?
Okay. Well, first of all, the way I chose and companies that were invested there is, and you won't see any exploration stories there, okay? Because I was thinking I want to maximize the relationship between return and divided by risk. I want the risk lower and the numerator, the return higher. And the most important part is reducing the risk. And so I said, all right, how am I can do that if in fact what I do is invest in profitable producers, because they aren't going to have the risks that the explorers do, where they don't have to raise money every year. They don't have to get permits. They don't have to try to hire people who know what they're doing, et cetera, et cetera. There's all these risks that the explorers have that you don't have if you invest in a profitable producer. But then I said, oh, there are some producers who, under their umbrella, have development projects that will increase their production in the next 2 or 3 years by 50 to 100%. So you're basically getting an exploration development story under the umbrella of a very profitable, financially strong company. So the risk, you get the growth potential, but you don't have the risk at all. And so that's what I chose to do. Then the other thing, when you talk about when to buy and sell, I'm buying when I see that there's a company that has the properties that I've just described. There aren't a lot of them. Many of the big miners, they grow by acquiring other miners, but not by having internal growth like what I'm describing. So there aren't a whole lot of them that show up. But when you see one, then okay, do they have check all the boxes? And one of them is location. There's some locations on the planet that I don't care how good the company looks, I wouldn't go there. Like the Southwest Africa, for example. And because in Burkina Faso and Mali and all that, there's way too many potential issues there that you don't want to get near. But so the other thing is that because I'm looking at a frame of years, maybe 2-3 years, when they're going to actually cash in. So if you're going to buy a developer, you want to stay with it until they actually get into production. That's when then the price peaks. So in other words, as an investor, I don't trade. I will sell when these companies, when I've thought that they have peaked out in terms of realizing their potential growth through their internal growth. Then I'll sell it. So I may hold some of these companies for 2, 3, maybe even more years. So I'm not a trader at all. Now I do want to say and admit that I have another 20% in my portfolio where I acquire some developers that have qualities that I think are really, really strong. And so I'll have, but I won't put a lot in any one of them. But then there's a lot of growth potential there. But the risks are that they've got to raise money and they got to about. So I do go and get some like that just because they look like they're going to be successful. I'm not particularly sure of the quality of the project, the grade, where it is, the management, their ability to raise money, all of those things, and look at that and say, well, I think that the odds are good, and then I have several of them. But so I do dabble a little bit that way, but nothing like I used to. And the thing is, I mean, I made this change. I've been in this sector for a long time, since 2002. And over that period of time, when I look back and say, where did I make money? It was on near-term developers who went into production. But the explorers, I never made any money in all those 20 years in explorers because something would happen. And they couldn't get the permits. They couldn't raise enough money before the market rolled over a bit, and then everybody sort of gave up on gold, and that was another piece of it. But explorers they're like lottery tickets, actually, Charlotte. And if you get in and you at the right time and the right ones, if you're Rick Rule and you have better information, but there's people like that, they know all the people, all the projects, they know so much more than I do, that it's not a fair game for me to compete with those guys because I'm not going to win. And of course, then they always get in really, really early. So and then they usually take their initial money off the table on the way along because they get in at the IPO and all this sort of thing. So it's a game that I don't want to play. And, if there are people out there who want to do that, then God bless them. I hope they have good luck. But it didn't work for me. So I've just chosen, and particularly at my age, that I'm focusing on taking advantage of opportunities where they're there, but minimizing the risk. And so, as I said, for 2025, I couldn't have hoped for a better result. I've never dreamed I'd make that much money in 1 year. So anyway, that's my story.
Yeah. Well, I think that's really helpful. And it speaks to the importance of knowing who you are as an investor, right? Finding what works for you, doing what is comfortable for you.
Exactly.
So you found your sweet spot.
Most people don't understand the difference between being a speculator and being an investor. Investors basically buy something they're going to hold for 2, 3, 4 years. Whereas speculators are buying and selling and trying to trend follow the momentum and all this other stuff. That's just crazy making. I don't want to do that. That's at the minimum is stressful. But I guess if you get off on that, well, wonderful. But that's not me. I don't want to do that. I want to be able to enjoy my life and figure, okay, I'm in on the right trend in the right companies. I'm going to go out and relax and play with my grandchildren.
Yeah. So you feel set for now. Anything final you would add for the audience? Other things on your mind that you want us to think about?
Well, I would. We haven't talked about silver at all. I do think that silver will go up. I don't invest in silver bullion now because silver is too hard to keep. It's not just a monetary metal. It's mostly industrial. And it has two really quirky characteristics that make it odd to understand what's going to happen with it. 70% of the silver that comes into the market and supply side doesn't come from a silver mine. It's a byproduct of copper and zinc and lead and other things. Well, a copper producer isn't going to produce less silver if the price goes down or more if it goes up. So the price is inelastic in that respect. And then you got the demand side, where you have the different industrial kinds of demand for silver. And well, what's that going to be and how is it? I think that silver has been undervalued for quite a while. It's done very well recently, but I believe that there's a lot more in it. And the historical pattern of the gold and silver bull markets is that the gold leads and then the silver catches up and takes off in the latter part. But then when the thing ends, it crashes way, way, way more, which is why after like 2013 or whatever, a lot of the silver companies went out of business. And they went into the gold business, some of them that stayed around. But they were just devastated them because they couldn't make any money. So I have some silver, and right now I have, because of the fact that I own a couple of silver developers who did extremely well, one being Abra Silver. My portfolio is now about 30% silver miners. And I won't do any more than that. And I don't expect that to change much for a little while. But so again, silver is so volatile. I mean, it went up from $30 to what, 110 last year, and now it's down under 70 today. So yeah, it's. But I think there's room for the silver price to go up and catch up with gold, and for the gold-silver ratio to go down, because that's been the pattern. So I am doing a little of that. Maybe that's foolish, but I'm basing that on the history, but I'm not doing the silver bullion at all anymore. I used to, but I'm either going to be in the miners or not.
Well, and tell me if I'm remembering this correctly. When you're looking at the silver miners, you prefer to have them mixed with gold, if anything, not these base metals, silver
Oh,
type of
absolutely.
place. Yeah.
Yeah, I mean, my favorite, the silver producers or developers that I have any money in, the byproduct from those projects is gold, not zinc and lead and all that. I don't want that. I'm not interested in investing in zinc and lead. And so that's a much stronger situation, and the market loves that. That's why Abra Silver in particular, that's what they were strong. I think 2/3 silver and 1/3 gold or something like that. So that's a good situation, and it's in a good location too. It's in Argentina, which is really booming now as far as resources because of the new administration. And speaking of free market capitalism, study Argentina. That's a whole other story I encourage people to look at and see what Javier Milei has done in 2.5 years in Argentina, considering what a mess that country had been for ever since the 1940s when Juan Perón took it over and just destroyed it. And it's been amazing what he's done. So it's a good place to be mining now, and also in oil and gas and a lot of things.
Yeah, I know there's been huge progress just in the mining industry there in a very short time. So that makes a lot of sense. Yeah. Well, this has been really valuable as always. I think we kind of covered that past, present, and what we can do now. I think this was great. Thank you so much for coming on to share the latest.
I do so enjoy these conversations with you. It really gives me something to look forward to, and give me a sense that maybe I can be useful in my middle 80s.
Well, I always enjoy these talks. I look forward to the next one. I know our audience does as well. We always get comments wondering when you're going to be back. So we'll wrap it up for now. But yeah, we'll hope to have you back in the future very soon.
Oh, I'd love to. All right. Thank you again, Charlotte. It's always a pleasure to talk with you.
Yes, great to have you. Once again, I'm Charlotte McLeod with investingnews.com, and this is Don Hansen.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.